Michael George. I'm with Safe1 Credit Union. On behalf of Safe1 Credit Union and Moneywise Wealth Management, we'd like to welcome you to tonight's workshop on Social Security. As many of you know or may come to find, navigating Social Security can be a little bit complicated. Hello, good evening, as well as confusing. So that's why we're here tonight, so that you don't have to do it alone. Tonight's workshop is designed to get you the information you need in order to maximize the benefits necessary for your retirement. Our presenter tonight is here. He's out front. I'll be getting him then. Is Dustin Weaver. Dustin's a financial advisor for Moneywise Wealth Management, and he's co-host of the Moneywise Guys radio show and podcast. He's a certified financial planner and a financial advisor with over 15 years of experience. He holds a California state life and health insurance license, along with Series 6, 7, 63, and 66 securities licenses. It's impressive. It's 4 more than I have. Yeah. During tonight's workshop, Dustin, who's going to offer ways to maximize your Social Security benefits and also describe various claiming strategies, such as how married couples can enhance lifetime payouts, spousal and survivor benefits, the impact of working on future benefits, taxability of Social Security income, and Medicare. And Dustin is the expert on this, and I am not. So with that, I'm going to turn it over to Dustin. Dustin, please welcome Dustin.
All right. Thank you. Thank you. That sounded like a mouthful. We've got about, the last count, 6 hours worth of content beginning now. So hopefully, just kidding, 45 minutes to an hour maybe. We are going to open it up for some questions towards the end. What always happens in a Social Security workshop is you're going to have unique and individualized questions. We ask that you please hold on to those. If it's a complex question, we offer a complimentary one-on-one where you can come in and sit down with an advisor at Moneywise, and the team can definitely answer individualized questions. So we will take some general questions towards the end, but we do plan to cover a lot of different topics tonight. So the best slide is the disclosures. So Moneywise is a wealth management firm, and we are going to be speaking on generalized advice. This is not specific to your specific scenario. We encourage you to meet with your advisors and tax advisors, accountants, and attorneys as well to make sure that you're making the best decisions for you. So Moneywise likes to narrow down being Moneywise really into 3 different categories. We have wealth, tax, and estate. That's your overall financial plan. Really 3 critical areas that you want to maximize your overall plan. And so what does this have to do with Social Security? We look at all income sources as part of your overall wealth. And so be it Social Security, pensions, retirement plans, etc. Some of those have a balance. Some of those have an income stream. And Social Security we look at as part of your overall wealth when we're looking at your balance sheet and income statement for your overall financial plan. So we're going to jump into Social Security, but just talking a little bit more about Moneywise on the front end. Your financial plan is complicated, right? Social Security is just one aspect of many. We're looking at assets and liabilities, our income and expenses. We're talking about Social Security today, which is a retirement asset, right? As we mentioned, it's part of your wealth, overall wealth plan, but it's complicated. There's a lot of moving parts. And so if some of the things that you learned today, you can implement, great. If there's other things that you have questions about, Moneywise has a process to meet with you and discuss all these other topics in addition to Social Security. And so, as I mentioned, we offer everybody a complimentary one-on-one meeting where we can answer some individualized questions for you. And then should you choose to engage with us, we do comprehensive financial planning and investment management. What the process looks like, should you choose to work with us. This is taken from the Certified Financial Planner Board, CFP board they call it, process of coming together, discovering what it is that's important to you, what your goals are. We do a little bit of research, make some recommendations to you, help you implement those recommendations. And then the planning process is really full circle where you do that process again. You come together, you review, and make any changes should you need that. So what you came here for tonight is Social Security. So our commitment is to give you some sound and up-to-date information and to help you identify some goals that you may already be aware of, or maybe some other things that you hadn't really thought of. And so really our goal is to just have an impact and help you walk away with a little bit more value and knowledge on Social Security than you had before you came in today. Social Security is an income that will last a lifetime. Sometimes when I say that, people laugh a little bit because we've seen some of the headlines, some of the articles about the state of Social Security. And so hopefully when we go over some of the numbers tonight, you have a little bit more peace of mind knowing that it is going to be there and you can have confidence in it. So Social Security was enacted in 1835 by President Roosevelt. And at the time, actually, instead of telling you, I'm going to ask, what do you think life expectancy was back in 1935? How long were people living? 50, 59, 60, 62, very close. So men, 61, women, 65. No surprise there. It's still true today, right, that women typically live longer. But so here's this benefit that pays out at age 65 at the time. And that was life expectancy. So that's why they call it old age survivors and disability insurance, which you may have heard of that before. On your paycheck over the years, there's a charge that you have. You're paying around 6.2% of your income if you're paying into Social Security. Your employer pays another 6.2%, and it goes into this bucket of money that pays out for people when they retire. Well, you look at this, life expectancy was 65, and the payout started at 65. No wonder that it's going broke today. We're taking it at 65 or 67 years old and oftentimes living late 80s or mid 90s. And there are several centenarians living, over 100 years old these days. So the program was never meant to pay for 30 years. It just wasn't. It was meant to pay for those that were living too long at the time, right? So it is a pay-as-you-go system, meaning as you're earning, you've been paying into it, right? That's what they mean by that. 2.68 trillion is the current amount of money in the Social Security Trust Fund, and that's a 2025 updated number. So for a number of years, there was more people paying into Social Security than what the program was paying out. And so during those years, they add all that money that's not being paid out into this trust fund. And so that's why there's $2.68 trillion there. And so you might ask, okay, well, what are these headlines? What are they telling us? What's going on now? As of a couple years ago, more money is going out than what is being paid in. And so that becomes a problem over time, right? If there's not enough coming in and more going out, what are we going to do? If we did nothing today, the money can last until 2035, which is just around the corner, right? We're in 2025. That's about 10 years from now. And so obviously that's a problem. So they're talking about making some changes to the program to make that last longer. So how much money in 2035 is coming in compared to what's going out? Well, they can cover about 75%. So about $3 for every 4 that is expected to be paid out in 2035. So the changes they're going to have to make between now and then, they're going to have to make up that 25% difference. And there's several different ways that they could do that, and we're going to get into that here in a little bit. That's just a brief history. So the baby boomers retiring, obviously, those born from 1946 through 1964, they call the baby boomers. There was a lot of them. Those folks were paying into the system a lot. 10,000 a day are now retiring, and so those are the folks that are going into Social Security age and taking the benefits that they paid into. So who is eligible for Social Security benefits? The way that they quote it is you have to accumulate up to 40 credits, and each credit is 1/4 of work. So if you worked a job that you paid into Social Security, and I qualify it that way because not all jobs pay into Social Security, but if you paid into Social Security for 40 quarters, which would be 10 years, you qualify for a Social Security benefit of your own. If you're the spouse of an eligible worker, there's another benefit for you. We're going to get into that as well, discuss what that is and how it works. If you have an ex-spouse and you were married to them at least 10 years, as long as you're not remarried, there's also another potential benefit. We'll get into that a little bit more as well. And then a surviving spouse, that's in the event that you were married, somebody passed away, and they qualified, you qualify for a benefit known as a survivor benefit. We'll talk about that. So where can I get information on my individual security? Well, they have a website for it, socialsecurityadministration.gov. If you go to that website, right smack in the middle, they have something called My Account. If you click that, there's 3 different logins that you can create. They have 3 different ways for you to log in. You can create a password directly on SSA. There's login.me, and then there's a third one that slipped my mind right now, but there's 3 ways that you can log in. So who can claim benefits? So based on the year that you were born, as you can see in this chart here, it will determine what they call FRA, or full retirement age. At our full retirement age, Social Security has what they call a PIA, a primary insurance amount. This is your amount that they're looking at as your primary full retirement. Like that, they base everything off of this number. So if you were born in 1960 or later, as you can see here, your full retirement age would be 67. All of the benefits that they calculate, whether you take it early, whether you take it late, it's all based on the number of your benefit at age 67. So filing early versus later. So in the example that you just saw, if your full retirement age was age 67, you'll notice here that if you take the benefit early, like at age 62, which is the earliest that you can file for Social Security, you will get 70% of that primary insurance amount, that PIA, right? So we have the full retirement age at 67. They're saying, well, if you retire early, or at least not necessarily retire, but if you draw your Social Security benefit early, you're going to get 70% of the amount that you would get at age 67. The math is like 0.05% per month or something like that. It comes out to around 7% per year between age 62 and 67. And then it's 8%. They give you a little bit of a bonus as you wait from 67 to 70. You'll notice it jumps up about 8% per year. In the investment world, 7 or 8% return, pretty good. So the point is, the longer you wait, the higher the benefit's going to be. So should I take early at 62? Should I wait till 70? Somewhere in between. The inflection point, so the point of where those decisions cross, for most people is around age 80 to 81. Meaning, let's say you had 2 twin brothers that worked the same job their entire career, right? And come retirement time, one of them says, all right, I'm going to draw it early at age 62. And the other says, well, I'm going to wait until 67. Well, the 62-year-old's going to have 5 years worth of income where he's looking at his brother saying, see, why'd you wait, right? Here I am getting this money to spend, right? A couple extra vacations, couple extra things that I could do. Well, his brother saying, well, yeah, but when we live to age 90, right, I've drawn a lot more money than you. And that's true. And so when making that decision, life expectancy, family genealogy, family history, you want to take into account all of those different things. Obviously, there's no crystal ball. None of us know how long we're going to live. But that's really a point of inflection where the longer that you wait, the more lifetime benefit potential that you have. Spousal benefits, in order to qualify for a spousal benefit, you have to reach age 62. You must have been married for at least 1 year. Example, let's say there's a 2-person household. One person worked and the other person worked at home, which is the harder job a lot of times, right? My wife reminds me all the time. So if in that situation, the fact that you're married and one person paid into Social Security, just the fact that you're married, you do qualify for 50% of that primary insurance amount, so that age 67 benefit, if you also, as that spouse, wait and draw your benefit at age 67 as well. So as an example, let's say somebody had an age 67 benefit of $2,000 a month at age 67, and I'm their spouse. Even if I didn't pay into Social Security, just the fact that we're married, I'm entitled to $1,000 a month if I draw my benefit also at age 67. Well, what if I'm a spouse and I decide that I want to draw that benefit early? That scale we looked at earlier where you're penalized, you take a lower percentage, that is the same case for spousal benefits as well. So here's an example of what I was saying. So assuming a full retirement age of 66, and then we show it here at 65 just to confuse you. So this is inaccurate, but the benefit would be 50% at age 66, and then there's a small discount for each year before that if I'm a spouse drawing on my my spouse's benefit. So survivor benefit. The survivor benefit is one that kicks in if you were married and the person passed away. This is a benefit that you can actually draw prior to age 62. So it's as early as age 60 that you can draw a survivor. And so someone might say, well, how do I decide what to take? Usually it's the higher of the two benefits. Right? If your survivor benefit's $3,000, your own personal benefit is $2,500, what would you rather have? Yeah, the $3,000, right? So the Social Security office, when you go in and meet with them, or they can help you walk through that and get signed up for the highest benefit. The other thing is you do have the ability to switch back and forth between a survivor benefit and your own benefit. So why that might be the case, let's say you're 60 years old, spouse passed away, you can draw their survivor benefit, and then if you're continuing to work, your own benefit might potentially outpace the survivor benefit that you were drawing. And they're not mutually exclusive, meaning if you're drawing the survivor benefit, it does not have an impact on your own personal benefit. Say it again. Cannot draw them at the same time. Great question. Yeah, it would just be the higher of the two. Yep. So here's an example of how you might make that decision if you were in that scenario. So you can start your survivor benefit as early as age 60, and then switch to your own benefit later, especially with the fact that it can kick in at age 60, whereas all the other benefits are age 62. So there's a lot going on here. This is a pretty busy slide. Apologize for that. Let's just focus on the far right for a second. We've got Paul and Janet, and Paul's full retirement age is age 67. He's got a full retirement age benefit of $2,000. If he drew it early at 62, he falls under that 30% discount, right? So we take the $2,000 down to $1,400 a month. If he waits till age 70, he gets close to $2,500 a month. You see that Janet's full retirement age is $1,800. If she chooses to early at 62, it would be $1,260. What we're looking at here, if we focus just on the top for a minute, we've got 3 of these scenarios. Why are we doing that? Impact of a survivor benefit, because when you're making a decision to defer your benefit longer and you're getting that 7 or 8% increase on your benefit by waiting, that decision is not just for you. If you predecease your spouse, they would then be stepped up to that new higher benefit. Between scenario 1, 2, and 3 are really just Paul taking it at 62, 67, or 70. And you can see that the lifetime benefits, if Paul were to pass at age 80 and Janet ended up living 10 years longer to age 90, you can see the lifetime benefits 700,000 or 742 all the way on. So I don't know about you, but an extra 100 grand in retirement, I could find a thing or two to spend that on. So, especially as we're aging and there's inflation and we've got rising healthcare costs, that extra money can go a long way. So really think long and hard about, drawing early. I've seen several times where couples are just super anxious to retire and just get that benefit going, and they both take it at age 62. Sometimes that works out. It does. But there's been other times where we reach our 70s and maybe 80s, and that money doesn't go as far, right? So really do a lot of thinking on what it might look like for you in your individual situation. Question of divorce comes up from time to time. So what if I get divorced? What happens? So if you were married at least 10 years and you've attained the minimum age required to draw, and you're currently unmarried, you are able to draw a benefit off of your ex-spouse. Yeah, good answer. This is also true if that person married more than one time for 10 years. So there are scenarios out there where somebody's been married 2 or 3 times for 10 years or longer, and you've got that person drawing off their own benefit, and then 2 or 3 ex-spouses drawing on that same benefit, all from one person paying in. So no wonder there's a little stress on the system, right? So you are able to get retroactive benefits. There's a one-time lump sum payment of up to 6 months of retroactive benefits. And when it says the future benefit is based on the lower amount. Yeah. Thank you for mentioning that. So remarriage after reaching age 60 does not affect eligibility for survivor benefits if the ex is deceased. So if you remarry after age 60, you're still able to draw off of your previous spouse's benefit as a survivor. So as an example, if somebody had their own personal benefit of $1,500 a month and they've survived somebody that their benefit was $2,000 a month, as long as you remarry after age 60, you can still draw that survivor benefit. Yeah. Thank you for pointing that out. So you do have the ability to make a retroactive payment, and they're not available for any month before your full retirement age. So let's say you saw these charts and graphs and you had the conversation and you said, I'm going to delay my payment as long as possible. I'm going to take it at age 70. Well, and then life throws you a curveball at age 68 where you could use the money, right? You have the ability to look back and say, well, I don't want to just take the benefit now at age 68. I think that benefit 67 and a half looked pretty good. Can you give me some back pay of the last 6 months? You are able to do that one time. And when it says the benefit's based on that lower amount, it would be based on your age 67 and a half because that's what they're basing the payment on, right? So you get back pay, but then the payment going forward would be lower. You do get a one-time chance to do a reset or a do-over where you've changed your mind. So at the time that you file, if you change your mind, you do need to pay back all of the benefits. You can go back or make that decision up to 12 months after you decide to draw. Because as we all know, life throws curveballs and circumstances, and sometimes there's opportunities. I know folks that retired from an oil company, for example, and took a severance package, and they thought they were done, right? And then 6 months later, someone's knocking on the door. Hey, you're a pretty bright person. I want to bring you on as a consultant. I'm going to pay you pretty good money. They go, oh, well, I've already got the Social Security coming in. You can reset that decision one time, as long as it hasn't been more than 12 months. COLA. Anybody heard that word before? Not Pepsi or Coca-Cola, but COLA is a cost of living adjustment. So there is a built-in inflation protection, we'll call it, that says as the consumer price index goes up over time, that's a It's specifically there's different types of consumer price index. They look at the one that's tied to what a urban or clerical worker would have in their day-to-day expenses. As those expenses go up over the years, milk and eggs and bread cost more. The Social Security does have eggs. Eggs a bad example right now, right? They're costing a lot more. As those things cost more, your Social Security benefit does increase over time. On average, 2.6% since 1975. Okay, well, if Social Security was around since 1935, why are we saying 1975? Because that's when the automatic inflation adjustment kicked in. It was in 1975. So they look at this consumer price index and they say, all right, things have been going up recently. In recent years, these numbers have been a little higher. 8.7% increase in 2022 is a pretty good uptick on Social Security. So often we get the question, well, do I take it early? Do I take it late? What are some scenarios or maybe some reasons that somebody might want to take it early? Frankly, if you need the money, right? If your income is changed and you need to take it, right? Yes, that break-even point at age 80 is going to come around, and you might think, oh gosh, had I waited, it would have been nice to get more money. Sure, but if you need the money, take the money, right? Obviously, if health or life throws you that curveball, and you're in a situation where you can't work, income has changed, obviously a great reason to take it early as well. Some reasons to delay: you don't need the money, right? It's the opposite of you do need it, right? If you don't need it, if you've got other sources of income that can help you bridge the gap. Where I see this second item here most often in a conversation where I would bring it up, if you're a very conservative investor, meaning the type of person that says, Dustin, I like that under the mattress kind of investment. That feels safe to me. I like CDs and money markets, and I'm not worried about that, mutual fund and stock market stuff. I'm a very safe-minded, conservative investor. Great. Let's use some of those retirement savings now in the early years of retirement and let the Social Security go up, because it's guaranteed to go up that 7 to 8% per year, which, as I mentioned earlier, is a pretty good investment, right? So if money market rates that you're happy with, you're paying 3 and 4% right now, and for a number of years they were paying a lot less than that, right? 0.1 to 1%. The return on investment is just fantastic by waiting and delaying that Social Security as long as possible. So that would be one example. If you think you're going to have a longer life expectancy, we say that because, again, the break even is age 80 to 81 on average. If you live longer than that, you will have benefited by earning more money by waiting and delaying the benefit. Money you can count on. So it adjusts for inflation. It's backed by the US government, and it will pay you as long as you live. Sometimes we get kickback on that, right? Well, you just told us that 2035, it's falling off a cliff, right? What's going to happen? There's a lot of different ways that they're going to make up that difference. Do we know exactly what they're going to do right now? No, we don't. They have about a 25% gap that they have to fill. They can fill it a number of different ways. They can fulfill it through higher taxation, which right now, if you're working, you're paying just over 6% of your income to go to Social Security. Your employer kicks in another 6%. And that's for people that earn up to about $165,000 of income. They can up the percentage that you pay. They can up the percentage that the employer pays. They can raise the income limits. They can do what they've done with some other things, like there's something called a net investment income tax. If you earn $250,000 or more, you pay a little surcharge to kick into Medicare. It's around a 3.4% tax. So they can get creative with taxation to help put more money in that trust fund so that the money lasts longer, which gives us peace of mind, right? The other thing, and it's the one that people are most concerned about. Well, yeah, but what if they give me less money? I want to take this benefit now because I don't know if it's going to be there. Well, again, they're 25% short. So if they chose to make that decision and that decision only, yes, it would be a 25% pay cut. Do we think that they're going to do just that? No. There's a lot of people that really depend on Social Security, and it's a main source of income for a lot of folks. Those folks are voters, right? So we can't see them coming in. I know government does funny things, but we can't see them coming in and just haircutting everybody 25% across the board. It doesn't make sense. There's a lot of other ways that they can increase the dollars that they need to make it to where we can have confidence that we can count on it. So some factors that can impact your Social Security and the payments are taxes. There is a retirement earnings test, which we'll talk about. And then Medicare premiums have an impact on Social Security as well. So we'll talk about that. So what percentage of my Social Security is going to be taxed? It depends. Depends on the other sources of income that you have. So they have what they call a combined income formula, where they take the adjusted gross income plus tax exempt interest that you have, and they add half of your Social Security benefit to that. So in the example of a $2,000 a month benefit, that's $24,000 in a year. Half of 24 would be 12. That would be the Social Security benefit they'd add to your other sources of income and say, what is that total? And am I single or married? You can see the numbers here for 2025. Let's say you fall into the category here where you're married filing joint and you have 32 to 44,000 of income. Half of your Social Security would be taxable. Okay, well, what if our income's over the $44,000 number? We make $60,000 a year as a married couple. They will tax your Social Security benefit 85%. I said that wrong. It's not an 85% tax. It's 85% of the Social Security is taxable, meaning 15% of the Social Security would be tax-free. So it's never 100%. So whatever benefit that you get, you're not going to be taxed on 100% of that income. There are strategies that we help people implement to help, be wise about how much income that we have so that we potentially pay less taxes on that Social Security. So the retirement earnings test also comes up. And what that is when somebody comes, and it's often the person that has the attitude of, well, I'm going to draw this early. I don't care. I'm still working. I might not even need the money, but I'm going to draw it, right? That person is often surprised when they come to find out that there is an earnings test that kicks in. And what that is, if your full retirement age is age 67, for example, every year before that, so if you started drawing early at age 62, every year between age 62 and 67, the IRS is going to look at your income and say, okay, well, if you earn more than $23,000 outside of Social Security, we're going to deduct your benefit by $1 for every $2 over that number, right? So as an example, if someone earned $33,400, so 10 grand more than that, their Social Security benefit would be reduced by 5,000. They made 10,000 more than that number, so they take a haircut of half that, $5,000. In the year that you reach full retirement, it's a little bit different. You can make more. It's up to $62,000. Anything above that, they're penalizing you $1 for every 3 above that number. So if you start drawing that Social Security benefit and you're still working, it's earned income. Well, Dustin, what if I have investments or rental property or these kinds of things? Not that. Earned income. So you're going to work, you're earning the income, not your passive investments. They don't penalize you for that. Okay, that makes sense? Okay, Medicare premiums. Medicare premiums are factored into your Social Security payment. It's not an option. They reduce your Social Security benefit by your Medicare premium. And when I say Medicare premium, there's different parts of Medicare. So the vast majority of people do not pay for what's called Part A, which is your hospitalization insurance. But your Part B, which is the extra medical outside of the hospital, think like your normal primary care physician kind of coverage, you have a premium that you pay, and your share of cost is automatically reduced. Your Social Security benefits automatically reduced by your share of cost. And we'll talk about that on the next slide here. So who pays for Part A? Anybody that did not accumulate those 40 quarters that we talked about earlier. So and there's a couple of different tiers. So where I've seen this, let's say there's a married couple, somebody was working early on, and then they stayed home and they did not complete the full 40 quarters. They didn't work 10 years where they paid into the Medicare system. There's a couple of different numbers you see up at the top there. It could be anywhere from $285 to $518 based on how many quarters you did work. So if you put in 8 years of work instead of 10, well, you're not quite at 40 quarters. Your share of cost would be $285 for your Part A. For everybody else that did work 40 quarters or more, your Part A is included in the premiums you've already paid. In that, most people that have worked 10 years or longer don't pay for Part A. Now, Part B has its own schedule. You'll notice here where it says for lower income beneficiaries, $185 is this Uncle Sam, right? You've heard Uncle Sam. There's an aunt involved here too. We call her Aunt Irma. Who's Aunt Irma? Income related Medicare adjustment, IRMA. And this adjustment kicks in if we have a certain income level that is higher than normal, which means that our Part B, our share of cost is more expensive. The IRS is always looking 2 years back at your income and what the income level was at that time to determine what your share of cost is. And where we've seen kind of the biggest impact, if you have a high earner that retires, they're drawing Medicare around age 65, and they get surprised by this bill. Hey, I thought Medicare was only $185 a month. Look what Social Security did. They took $260 or $300 a month. What's going on here? Well, when you were working 2 years ago, you had a high income, and that said, and why I'm going on about this, is there is a form that you can fill out with the IRS that says, hey, I've had a substantial change of circumstances. I was working, now I'm not, I'm retired. Can you look at current numbers instead of 2 years ago? And they will do that. And so you do have the ability to get that lower premium. A lot of folks don't know about that, so we're trying to get the education out there so that you can learn that. Oh, sure. That's right. Yep. Yeah. Thank you. SSA 44? Yeah. Thank you. So when should you enroll in Medicare? Well, if you enroll in the 3 months leading up to your 65th birthday, that's when your coverage starts. I know you came to a Social Security workshop and you're wondering about why we're talking about Medicare, because obviously it has an impact on Social Security, and it's timely because it kicks in around the same time. So if you enroll 3 months prior to age 65, that's when your coverage will begin. If you wait until the month that you turn 65, you're going to have to wait a month after until the benefit kicks in. And then you can see these other options here too. You can end up, if you procrastinate a little bit, not kicking in until 2 or 3 months after you turn 65. This is an example of the taxability of Social Security benefits, like we were talking about a little earlier, and how with doing a little planning ahead, if you have the time and the runway to plan for it, where getting some assets into a Roth IRA, if you don't already have that, can have an impact on the amount of taxes that you pay. So here's an example of two different couples that have some interest from their CDs and savings accounts, money markets, maybe some dividend income, some tax-free bonds. But really the difference between couple 1 and 2 here is this IRA income, with some of the money being traditional versus Roth. You'll notice they have the same total income of around $67,000, but couple number 2 really benefited by having some of that tax-free income that didn't impact how much taxes they're paying on their Social Security. So this is just one area that, working with a financial planner that's versed in these things that can help you walk through and make better decisions. Obviously, that's a shameless plug. It's the work that we do, but we can have an impact and help you save on taxes. So Roth IRA distributions are tax-free. They're not included in the gross income, as we looked at on that last illustration. And there's also no required minimum distributions from Roth IRAs. I'm a huge Roth IRA fan, if you can't tell already. If you're not already contributing to one and you find that you are qualified for it, I highly recommend that to most folks. That I know I'm not supposed to give generalized advice or specific advice up here, but general rule of thumb, Roth IRAs are a fantastic tool. If you're at or near retirement and you didn't use that tool, that's okay. Tell your family members that are younger than you. There's many benefits to the Roth, including how much you pay taxes on your Social Security. I can receive 2 benefit and 1 on my own work record. Want to take a stab? False. Yeah, that's right. So you can only draw on 1 benefit at a time, and most people choose the higher of the 2, right? And Social Security is going to highly recommend that and help you fill out the paperwork on that. We often get the question, yeah, but what about file and suspend? Well, that's an old strategy that's now we're no longer able to do. There was a strategy previously where you were able to file for your benefit and then suspend it and let it keep growing while you draw on your spouse's benefit over here. But they found that loophole and realized they're paying out more money than they wanted to and took that away. So will Social Security be there when you retire? You know, obviously there's a lot of pessimistic news, and we talked a lot about this earlier. Americans worry about it, and they have the question, what's really going on here? So back in 1950, there were 16.5 people paying in for every 1 person drawing a benefit. And now in 2025, there's only 2.3 people paying in for every person getting a benefit. So that's another reason that it's really taxing that system, right? We talked about earlier how it was for people turning age 65 and life expectancy was 65. Well, now people are living a lot longer than that, and there's a lot less people paying in. So there's definitely some things that they need to do to make that better. And then the projection 10 years from now in 2035 is about the same, 2.4 workers. So the trust fund's likely to last till 2035. There's a shortfall of the 25%. And then as we talked about, they're looking at increasing taxes or reducing benefits, but it's definitely not going away. So some of the decisions that can affect your retirement lifestyle is, do I transfer some assets into that Roth IRA? Since as an illustration that we looked at, there's definitely a lot of benefits to that. That's something worth exploring, whether you are a do-it-yourselfer and decide to learn about these things and sit down and really try and figure out, hey, is this a strategy that I can, based on my other sources of income, if I can do? Or you can sit down with a financial planner that can help you walk through this. Mike, did you have a question?
I have one other question too. If you're a husband and a wife and you're at full retirement age, you can not take your own benefit and take the benefit of the husband and let the other one grow at full retirement age if the other spouse is receiving benefits.
So that was a strategy, but
No, it's still good,
for certain people
but you have to be full retirement age to do that. They haven't changed that in the law.
So say it one more time.
Okay, if there's a husband and a wife, and the husband is receiving benefits and he's past full retirement age, when the wife hits full retirement age, she doesn't have to elect her own. She can draw 50% of his, let hers grow to delayed retirement credits at age 70. That has not changed.
Okay. Yeah, that sounds right.
No, you said earlier, the spouse can draw.
Yeah, if you're saying if they're still working.
Well, they can work or not, but once the husband is on receiving benefits and the spouse, when she hits full retirement age, there's no earnings test. So she can file on her own record, on his record, let hers grow for delayed retirement credits at age 70.
Yes, if they're still working, because what they're doing, they're looking at the highest 35 years of your income. I should have brought that up earlier. So if you have a working career of 40, 45 years sometimes. What Social Security does is they're looking at the highest 35 years. They're taking into account the highest 35 years. So obviously our first few jobs probably aren't our highest paying, right? So we want those years to fall off, right? Back when I worked at a video rental store like Blockbuster, when those used to exist, that was my first job. I want those earning years at $5.25 an hour, I think it was. Let's let those years fall off. Let's let these current years build that benefit up. So yes, if you're still working, you can maximize that benefit for sure. So some steps to helping you achieve retirement success is continuing to increase your knowledge, keeping a big picture perspective, and consider working with an advisor. What do we mean by continuing to increase your knowledge? Here's a few resources. If you wanted to snap a picture, we'd be happy to email you these. They're also pretty easy to find. The Social Security website, ssa.gov, has some planning tools where you can type in your specific scenarios, and it'll help you do the numbers based on your own benefit. And then obviously getting your statement too. It's pretty straightforward. I'm sure many people in this room have gotten their statement. They chart it out for you and say, hey, here's the assumptions that we have. Here's your current age. Here's your full retirement age. If you keep earning the money that you're earning today, here's what your benefit might look like at age 62, 3, 4, all the way up to age 70. So keeping a big picture perspective is, taking into account not just the Social Security, but your other sources of income in your overall plan. And really planning comes down to income and expenses, your assets and your liabilities, really trying to balance all these things. And so Social Security is just one aspect of your overall plan. And so be thinking big picture as you're making these decisions. Try not to lean in just, that decision of when do I take this? Is it 62 or 67? I mean, people get really worked up and stress a lot about it. Just try and keep a big picture perspective is our suggestion. And then obviously being mindful of taxes as well. So you can take these strategies and do them yourself. You can work with others that you trust and know and like. You can work with us at Moneywise. We'd be glad to sit down and do an analysis for you. We have a tool that we can take your benefit and a spouse's benefit, or if it's just a single person, just your own personal scenario. We can help you run through the numbers based on your own unique situation. That's something we offer complimentary. Obviously, it's a way for us to build a relationship. We have lots of other services should you choose to engage with us, but just know that that's an option. We're happy to help. Or you could procrastinate and kick the can down the road and make the decision later, like they're doing with the Social Security solutions, right? But thank you all for coming tonight. That's what we had for the workshop. We can open up for a couple generic questions. If there's something very specific and unique, we might have to do some follow-up, but we're happy to take a couple questions.
Yeah, so my question, with the potential hit of 25%, let's just say they choose to go with only that option. So everybody takes the haircut. From a financial planning perspective, should that change our strategy of early or deferred withdrawal, whichever one we're kind of heading towards or might need to do at that time?
That's a great question. And there's a lot of unknowns there, obviously. We don't know what they're going to do. But if that's what they did, you're still getting the benefit of the 7 or 8% increase. And so for that reason, a lot of what I hear and read is the recommendation is to still defer. So yeah, don't take it unless you need it.
And I'm just curious about this. The 75%, is that based on like a PIA, FRA PIA, or an MBA at 62, or, I mean, are they basing that on if somebody was just FRA? Is that where they're kind of coming up with the 75% hit?
The 75% hit, or
I mean the 25% hit.
Yeah,
Say you're going to say your benefit is $1,000, your PIA.
Mm-hmm.
So now your PIA is going to be $750.
Right.
So
it would be across the board.
Whether so now it's going to be lower.
Yeah,
okay, so
it would be lower across the board by that percentage. So whether it was at 62, so in the first example we looked at of a full retirement age of 67, let's say it's $1,000 a month for easy math. The benefit as it sits today, if you take it at 62, would be 30% haircut. You're down at $700 a month, right? If that 25% is the way that they, if that was the only decision they made to make it settle out, then you take a 25% hit on the 700, is the way I understand it.
The 700.
If you drew it early at 62.
Okay.
Yeah, because you're basically being penalized twice for taking it early and for them making the adjustment to make the trust have money longer.
Hi, can you speak about the windfall provision?
Sure. So what she's asking about, the windfall provision, and there's also some abbreviated as WEP, if you look it up. There is also a GPO, which is a government pension offset. What those two provisions were, past tense, good news. What those two provisions were, where a lot of our school teacher friends or folks that were working for another government, state, where they had a government pension and they also had a Social Security benefit. What was happening is they were looking at that Social Security benefit and saying, well, you're double dipping, you're getting both benefits, so we're going to penalize you. And they would offset that income from Social Security. The way they looked at it was, how much is that other pension that you're getting? And they offset your Social Security, and it could be pretty substantial for a lot of families. So recently, the first of this year, there is a act that's been passed, and they are retroactively for the last 12 months or so. It was a retroactive decision where they're getting rid of that. So there is no longer a windfall elimination or a government pension offset. And there's a lot of folks that have been getting deposits because if they've already been receiving benefits, Social Security is going in and calculating that and saying, well, here's the amount we were penalizing you, and we're not going to penalize you anymore. Here's the last 6, 8, 10 months, whatever it is.
It's retroactive to January of 2024.
There you go. That was the 12 months that was sticking out. So it was approved January of 25, but retroactive to January of 2024.
That's right at the full retirement age.
What's that?
It's based on your age. You have to be full retirement age to get that back 12 months, yeah. That would be full retirement age.
It's not based on your age.
Yeah, it is. I mean,
Good news is it's been canceled. So going forward, it's great news for folks that had that offset.
Wait, let me. Okay, I'll get everybody, I promise.
Thank you for that question, by the way.
I haven't worked in a couple of years and now I've applied and I've been approved. And I didn't notice while monitoring it any change in the amount. So COLA only kicks in once you start receiving?
Right.
Question? Okay.
Well, no. So the COLA is having an impact on your benefit even before you're receiving.
As it's just sitting there.
Correct.
Okay, cool. Thank you.
Yep.
Yes, if you have to go out on a medical and draw a state disability, can you still draw your Social Security?
Great question. So Social Security disability, I should have had a slide for that, and I'm going to add it. Thank you, sir, for asking about that. If you draw Social Security disability, oftentimes that benefit is higher than the early retirement age, like age 62 or 3 or 4 type benefit. And in addition to that, if you're drawing Social Security disability, there's another provision where you can actually get Medicare. Once you've been on disability for 2 years, you can get Medicare prior to age 65. So that's another benefit of disability. But your question was, can you keep?
I'm currently drawing Social Security and I currently work. But if I went out on state disability for medical reasons, would I still be able to continue to draw my Social Security as well?
You would get the higher of the two benefits, not both. So the question was for listeners online, if I am still working today and I'm drawing Social Security already and something were to happen to me, I became legally disabled and was qualifying for Social Security disability, can I draw both benefits? And the answer is no, you get the higher of the two.
Question is, if the doctor puts me on disability for, say, 90 days, can I still draw
You can get the short-term state disability and Social Security at the same time. What I'm saying is the Social Security disability, you cannot draw that and a Social Security benefit. Yeah, in addition to the getting Medicare early, if you're in a disability situation, there are a couple other exclusions or instances where you don't have to wait the full 2 years. And that's for ALS, Lou Gehrig's disease, or end-stage renal disease. If your unfortunate situation that you have that kind of diagnosis, you qualify for Medicare right away. They don't want you to, I say they, the government's graciously saying, look, we're going to help with those expenses with Medicare to where your financial situation isn't an extreme burden, because those are really tough situations to be in.
If there's a married couple and one of the spouses has not worked at all, can they draw on the other spouse's Social Security?
So
Even though they've never worked, they don't have the required 40 hours? 40
yes.
credits?
So the 40 credits
Credits.
that we were talking about was for your share of cost for Medicare, for your Part A, and how much you have to pay. As long as you've been married for 10 years, it doesn't matter that you didn't work and pay in the system, you qualify for a spousal benefit. That spousal benefit is also, if taken before that person's full retirement age, is also reduced. So quick example, married couple, they're the same age, and person A's benefit is $2,000 a month at age 67. Person B's spousal benefit would be $1,000 a month at age 67. If they drew it early, they're penalized. It'd be less than $1,000 at that same rate. So that happens sometimes where one spouse draws one benefit, the other defers theirs, and there's a penalty either way if you take it early.
Let me, and then I'll get you. Yeah.
Okay, question is, are pensions considered earned income when it comes to the retirement earning test?
No. When it comes to the taxability of Social Security, yes. But as far as the penalty of that $1 for every two over those different income thresholds, no, you're not penalized for that. Yeah.
I got two questions.
Sure. We got two questions.
So, if you're drawing disability from the VA, that doesn't affect your Social Security at all, right? Oh, I'm pretty loud.
No, I prefer the online. So
Oh, okay. So if you're drawing VA disability, does that affect your Social Security?
I would want to follow up with you.
Okay.
Yeah.
The other one is, would the bill that's going through right now in Congress, they're talking about not taxing Social Security. Is that, if that goes through, are we talking about that portion goes away?
That would be nice. Right?
Okay.
For a lot of folks. But I don't think that your Social Security, not 100%, but I don't think your Social Security is impacted by the VA benefit that you get. And the VA benefit, specifically from disability, is often tax-free. So it's not part of the equation at all. So there's a lot of good planning that can be done there. But I'm like 98%. I just don't see it too often, so.
I have a couple of questions. First of all, my husband worked for the Postal Service for 40 years. I worked for the city for 31 and a half. Because we were public employees, we had the choice of not paying into Social Security.
Mhm.
I understand now since 1987, everyone pays into Social Security. However, the federal government made the postal employees pay 3% of their salary for 10 years to qualify for Medicare.
Mm-hmm.
And they had to pay their share and the government share, 3% of their salary for 10 years. So my husband and I were married for 51 and a half years before we divorced. I realize but I don't know if he had 40 quarters because he worked prior to working at the post office. So wouldn't I be entitled to get Social Security? Because I don't get Social Security. I don't have 40 quarters because I didn't pay in because we chose not to.
So you don't have the 40 quarters paid into Social Security, and you're wondering if you'd qualify?
I'm not even near. I got $7,000 that I paid in the total time of my work when I was in high school.
Yeah.
They just sent me a statement, believe it or not, today, and I'm coming to this meeting. And that's a
great.
waste of our taxpayers' money. There's 4 pages there and I don't qualify for Social Security.
Yeah. You
And
could
it's
always,
in this
mhm.
nice 5 and not, 6-inch envelope. I read it before I came just to make sure that it wasn't something I needed to ask
No.
questions.
Yeah, I would still recommend that you go talk to the Social Security office about your unique situation and find out. There could be something there, but doesn't sound like it.
And just to clarify, because I'm quite familiar, I belong to the Retired Public Employees Association regarding that week thing. President Biden signed that in before he left December, retroactive back to January of 2024. Some people are owed thousands of dollars that the government's never going to pay because they took their money. They took $1 for each 2 that you earned from Social Security. And that'll never happen if the government's going to go back and pay all of those lost money.
Yeah, certainly a lot of unique situations out there, some of them tough for sure, but definitely have a lot of teacher friends that are very excited about the repeal of that windfall elimination and government pension offset.
Going along with that, on the windfall, on the Elimination Act of that, as a former teacher, but I'm also paying into Social Security now with my current job.
Mhm.
When I get to retirement, I could take my STRS and the Social Security, or
So if you've paid in those 40 quarters
Mhm.
and qualify for a Social Security benefit, yes.
Okay,
And that's
perfect. Thank you.
that recent change is what's really helping you. And then, so another big one, it also applies to spousal benefits. So in the event that your benefit, and I'm just saying this because of the number of years that you put in, let's say that your benefit is here and a spousal benefit is up here, you want to take that spousal benefit that's also not impacted by that windfall elimination anymore. So even spousal benefits can be really impactful.
We have a question. I have an HMO that is paid by my late husband's retirement annuity. Do I still have to apply for Medicare?
They have an HMO that's paid for by their late husband's
Retirement
retirement
annuity.
annuity.
Do I still have to apply for Medicare?
I believe it's yes.
Yeah.
Yeah, at 65.
Actually, it would depend on the carrier themselves. Some do not have a requirement to be on Medicare. So they should contact their carrier.
Very good. Thank you.
Uh,
I know there are some unique situations. Do you mind me asking where you learned that, or is it a certain government, or?
I'm a Medicare advisor, Kern Golden Girls.
There you go.
Oh, okay.
So any Medicare questions, you can happy to answer.
Yes. Thank you.
Thank you. My question, if one spouse is on state disability Social Security, when the other spouse is eligible to get Social Security, is that other spouse to compare to see which is the better pot? So is the other spouse measuring the actual units the first spouse worked compared to the spouse that's retiring to see which would be the higher payout?
So everything is based on your PIA, that primary insurance amount. So if the spouse that's drawing disability is drawing disability, that's not the number they're going to look at for the spousal benefit. It's going to
Okay.
be the primary insurance amount at their full retirement age of, in this example, 67.
And are they looking at the full retirement age for the spouse that's retiring? I mean, excuse me, that's eligible to collect, when they reach the retirement age.
So
Yeah.
at the age that you collect is how they're basing the benefit. So if that's 63 and your full retirement 67, you're going to have that reduction of benefits for those few years.
And the survival benefit, is that still allowed if they're on the state disability Social Security?
Yes.
They're not basing it off what their current check is then on the state disability?
Well, I'm sorry. The survivor benefit should also be based on the primary insurance amount.
Hold on.
I was just wondering, you said on one of those slides about putting money into a Roth IRA. Is there ever a point where it's not worth it to put it into a Roth IRA because you may have to have a huge tax bill in that particular year? And then I just want to know if when you start taking your required minimum distributions, does that amount affect the taxable amount of Social Security?
So 2 questions there. The
Yeah.
first was, does it ever make sense to not do a Roth IRA?
Yeah.
Certainly. Yeah. If you're in a high tax bracket, which that's a subjective term, right? Each person can make that individual decision for themselves. I personally think a 12% and sometimes a 22% bracket is a favorable bracket. If we look at percentages of taxes over the last 100 years, believe it or not, it's actually, we're paying less than average right now in that range. Looking at the amount of debt that we have as a country and knowing the main way they pay that back is through taxation is why I'm a huge fan of getting as much as we can into Roth and other tax favored accounts. But yes, if you're in the 32 or 34% bracket, that might be a little expensive to get money into a Roth. And then will you repeat the second question, please?
Does the money from the RMDs affect how much of the Social Security will be taxed?
So the question is, does the money from my required minimum distribution, or RMD, which is money that you're forced to take out of your tax deferred retirement plans, impact the taxability of Social Security? Yes. They're looking at the modified adjusted gross income or adjusted gross income, which includes that RMD amount. Another little plug for the Roth IRA is there are no RMDs on a Roth. So in years that you're able to get money into a Roth through contributions or what they call a conversion, huge fan of that. You cannot do a conversion though in your RMD years. So you want to do it prior to those RMDs kicking in at age 73. So.
Do you have tax deferred accounts ready to do it before you start taking out?
I'm sorry, I couldn't hear
If
you.
you have the tax deferred accounts, 401k, you should do it before the R&D.
Yes, and the answer is you have to. So you cannot convert to a Roth any dollars that are part of your required minimum distribution. You can convert dollars above and beyond that. So quick example, if you had a $100,000 account, your RMD was $3,600. You can convert dollars above the 36, but you can't do a conversion to meet your RMD. Yeah.
I have a question regarding survivor benefits. Make sure I understand it. You had the example up there, I think it was Paul and Janet, and they both were taking Social Security, and I think Paul, the husband, was deceased at age 80. And if I looked at the slide right, that when he was deceased, his spouse received his full benefit.
I don't know where that picture came from. Oh,
Right there.
There we go. So Paul and Janet.
Right.
Scenario 3.
She gets his, basically she gets his benefit amount if he dies, if they're both taking it beyond full.
Yes. So
several
if Janet
examples.
draws at 62, Paul waits till 70, right? Paul's benefit at 70 is the 2480. Janet's benefit at 62 is 1260. So this is saying their combined benefits are 1260 for the first few years, mostly
Right.
because it's just Janet's benefit. And then after that, they're making 3,700 a month. And then if Paul passed at age 80, her survivor benefit now jumps from the 1260 all the way up to 2480.
So she gets the 2480.
She gets the
Okay,
2480.
so as I follow that, so where I got confused was earlier in the discussion, in the presentation, you were talking about the 50% survivor, and there was that 50% graph. And if you can just explain to me the difference between the 50% and what's going on here on this slide.
So the 50% is not survivor, it's spousal benefit. So what that's referring to is in Paul, yes, you're welcome. In the Paul and Janet example, so in the Paul and Janet example, if his benefit was $2,000 a month at full retirement age, her benefit at her full retirement age would be half of the 2,000. So it'd be 1,000 a month. If she pulls it before that, like at age 62, she gets 38% of his 2,000 a month. So it's less than half. She's penalized for taking a spousal benefit before age 67. Does that make sense? Okay.
Dustin, we have a question from the audience. Is my CalPERS pension counting towards the earnings test?
No, it's a pension. It's not earned income.
That's separate.
Great question. Yeah, time for a couple more if you got it. Go ahead.
The windfall will it allow teachers to get survivor benefits from their husband?
Yes.
Spouses?
Yes.
Can you repeat it? Yeah, it's online.
The windfall allow retired teachers to get survivor benefits from their spouse.
It's their own benefit, survivors, and spousal benefits.
Is there an easy way to get a hold of Social Security?
Oh, just call them.
That's more complicated. Yeah.
But there was a follow-up.
Yeah.
You had answered about the HMO that's paid in my late husband's retirement. The response you gave was that they should contact the carrier. Because there was a follow-up. Does that mean I pay both? They should contact the carrier.
Medicare is different. It depends on their situs state where it's held at.
Let me have you. It's really online.
Don't give me a mic, I'll start singing. It depends on every state and it depends on the situs of the state. So wherever they're located, it may not be in California and every state is different.
I have something I can help this lady. The best thing to do if you have to contact Social Security, if you go in the office 3:45, because they don't do appointments anymore, they'll set you up an appointment and then they have to allow you to see somebody. And then you set your appointment. That's the way it works. That's the only way you can do it. If you call, it's almost impossible to get through, even if you call the 1-800 number. It's better to go in, whatever your servicing office is. And like I said, 3:45, they close the door at 4. If you're there, they have to see you and they'll set you an appointment. That's the way to do it for survivor benefits.
There you go.
Yep.
Oh, just a second.
We got a question from Mr. LaTroy, one of the advisors at Moneywise.
Yeah, so we're talking about the earned income test. Okay, if I'm 67 years old or full retirement age, let's call it like that, right? Am I subject to that earned income test?
If you're 67 years old, are you subject to
full retirement?
Full retirement age. So it's
Am I subject to that earned income test?
The question is, if I'm turning my full retirement age in this year, let's say it's this year, 2025, am I subject to that retirement income test? The answer is yes, up to the day that you turn 65. So let's say you turn 65 in April. Well, that $62,000 income limit that you're able to make, you can make the 62 grand up to April and still not be penalized for that year. It's only the year that you turn your full retirement age that they're looking at that number. Great question.
Is there a question here? No?
I did see a slide that said the maximum income you can make beyond Social Security for 2025 was 62,160.
And that's if you were turning full retirement age this year in 2025.
And the maximum age is 70. You can't put anything more into Social Security after 70 years old.
Correct. You cannot defer your benefit longer than age 70. They're going to force you to take it, which you'd be leaving money on the table for not. So you
Correct.
definitely want to take it at 70.
But at that point, you can make up to that 62,000 number
Great question. Let me clarify.
and still have full benefits.
Every year after your full retirement age, you can make as much money as you want and you're not going to have any kind of penalty. So if you
Outstanding.
defer your benefit to age 67 and you're still working, you can make $1 million. It doesn't matter. You're not going to be penalized because you waited till full retirement age. They're saying this is when we want you to wait till. We're going to penalize you before it, but if you wait till full retirement, you're good.
You got it. Great. Thanks.
Yes, I waited probably 14 months after my full retirement age to start my Social Security, and then I continued to work, and they immediately penalized me about $350 a month on my Social Security benefits.
And I couldn't tell you why that is, because the way it's set up is there's the year after you turn full retirement age, you should not be penalized.
2 months I turned, and I was 67. Draw, and they told me that I would not be penalized if I continued to work, but they told me from 27
So he's saying that his benefit got cut by about $300 a month, and he was earning money after his full retirement age. Are we sure it wasn't a deduction for Medicare or anything else? Your share of Medicare, maybe? Okay. Yeah, I'm not aware of a penalty that after your full retirement age, you should be able to earn as much as you want. The year you turn full retirement age, you have that cap. But every year after that, there should not be a penalty. Yeah.
Oh, here we go.
Back to the windfall, will Social Security automatically, if you're drawing Social Security on your own, automatically adjust my Social Security to be half of my husband's survivorship automatically?
So I heard two different things there, half of your husband's and survivorship. The half of your husband's is spousal benefit.
Right.
Survivor is different. That's 100% of his benefit he was receiving if it's more than what your spousal benefit would be. So those are two different things. But I would definitely talk to the Social Security office and make sure you're getting the most. If you're currently being penalized from the windfall elimination,
No,
they
I'm
are
not being
calculating that.
penalized. I received the back pay.
Oh, okay. That's good.
Okay. And I haven't filled out any paperwork.
Mhm.
So will I automatically receive my husband's,
Are you thinking your husband's survivor benefit is greater than what
I
you're
don't
currently
know.
getty? So it's the greater of the two.
No,
And
my Social Security, I'm doing on my own. Before I was a teacher, I had my 40 credits in.
Yeah.
So I'm a little bit, not a lot. But will that automatically go up to be?
for your case, honestly, I would talk to Social Security.
Oh.
Yeah.
I worked at Social Security for 13 years. So if by chance, if you never filed on your spouse's record, you have to file a claim. They don't automatically will put you on his record without filing a claim. Yeah, do the same thing like I told you what to do.
345.
Right, yeah, because the thing is, they don't know about his benefit amount. They only look at the retirement on your own record.
Yeah.
Quick question. If I'm 74 and still working full-time, can I apply for the retro?
If you're 74, still working full-time,
Can I, I'm
you look a
talking,
lot younger than that.
it's for a friend. I've been trying to convince her to
asking for a
retire for
friend.
years.
You definitely want to apply for your benefit at 70.
Yeah.
Yeah, you're leaving money on the table, and I don't
Yeah.
think there's back pay.
Yeah.
Sir, did you say you worked for Social Security? Did you ever see that scenario where somebody waited till past 70 and? Yeah. Yeah, there's no back pay. No.
Yeah. Yeah, she got, yeah.
Okay, the next hour, sir, if you want to come on up, you can, you got the next section? Yeah.
Oh, we got one here. Okay, all right.
I feel like I'm in pretty good shape just because I am a Moneywise client already. So thank you very much. That's a little testimony. I'll join Moneywise. And I feel like I've educated my children who are in their late 20s, early 30s to start investing in their in their working and everything like that. But I have family members who are of my children's age who don't work. They do things like sell things on Etsy and stuff like that. what happens for this next generation? Because there's a whole group of people out there that are not putting money into Social Security. What happens with my children because their cousins have elected not to invest? I don't know what their future looks like. I'm only worried about my kids' future. So just kind of curious to know, like, you talk about like the next 10 years, but what's happening after that?
Yeah, it's money in, money out, and they need to balance that, right? So if there's less money going in, they need to figure that out.
Yeah, I
Right.
have I'm not going to say who, I have a family member who works for cash, who's now 52.
Yeah.
Not going to work out well for that individual.
No, and that same individual will call my wife who does mortgage lending, and they'll say, "Hey, Ashley, I need this loan. I make all this money. I need
I
to
know.
qualify for this house. Great, prove it."
Yeah.
Oh, I can't do
Yeah,
that.
that's really none of your business.
What
now,
do you
is
mean
it?
they
Yeah.
won't give me a loan? I make
Yeah,
well.
I know. It's
Yeah, there's
it's
issues with
bad,
that.
bad situation. Similar to what
Yes.
you're talking about.
Yeah.
It's not me. No. Yeah.
Well, sincerely, thank you everybody for coming. We hope that you found some value in coming tonight. And is Debbie here?
She's out front.
No, she's out front. Yeah. Say thank you to Debbie on the way out.
Yes.
She really does a lot of work with getting this set
Yes.
up, all the paperwork in front of you.
Yes,
And then
please,
Safe1.
please fill out the
Thank you, Mike.
feedback forms. We will pick them up. We do actually read those and take heed and make notes and try to improve these workshops. So thank you for your time. And if you have any further questions, Dustin and Moneywise are always there, and I'm at Safe1. You can always call. So thank you.